We'll kick things off today with a conversation about the largest topic in real estate at the moment, and that's the likely interest rate cuts by the Federal Reserve. Now, there's a lot of great content out there covering what exactly is happening, who is involved, why is it important. For purposes of today's episode, our focus is going to be solely on the future. After interest rate cuts begin, what does the impact on the economy look like 12 months later? And there's going to be a few different lenses we're going to take a look at it from. From a historical perspective, going back to 1990, there have been 9 interest rate cutting cycles. And what we mean by that is could be something as simple as a one-time cut of 25 basis points, or to an extreme example, multiple years, multiple full percentage points being slashed. However, going back to 1990, 9 separate data points for us to look at for the Federal Reserve lowering their federal funds rate. And the narrative as we go into our examples here is that lowering rates is good for the economy. Businesses can more easily borrow to build new factories. Individuals can more cheaply borrow money for mortgages. Is this actually the case? So following the 12 months after the first cut, let's take a look at the stock market. So each bar you see here is the S&P 500 return for the 12 months following the first cut. Now, if you were to take a look at the long-term chart for the S&P 500, it's bottom left to upper right. Meaning if you were to reach into a hat and pluck out a random year, your expectation would be more often than not, the return for that year is going to be positive. And sure enough, when we look at our bars here, a lot of green, a lot of money being made. Sure, we have a couple outliers here for negative returns. However, overwhelmingly, if you were to invest money following the first cut, you are making money. And when we make our way from the left to the right, we see this one here labeled average. And this is going to be, if you were to take the average return for the 12 months following the first cut, your return for the year is going to be right around 7.25%, meaning you are making money. If you invest after the first cut, you are making historically a positive return. However, when we look at the one all the way to the far right, this is the historical average return for the S&P 500, the stock market, which is a touch over 10%. So what this is telling us is that, yes, if you invest money after the first interest rate cut, you are likely to make money from historical information. However, you're making less than the historical average would tell you should be making. So the narrative that interest rates coming down is going to be great for the stock market, from what we can see here, may not necessarily be the case. Now, that doesn't mean it's bad. It might just take longer than a full year for lowering rates to have an impact. But what we can see here is from a shorter term perspective, interest rates coming down does not necessarily mean the stock market is going gangbusters. Now, the stock market is not everything. The stock market is not the economy. The next data set we'll take a look at here is unemployment. Now, this is going to be U.S. unemployment change year over year. So in this case, a positive number is actually bad. That means unemployment is going up. And when we take a look at our bars here, we do see 2 data sets gravitating to the left, which means unemployment was decreasing, which is great. However, overwhelmingly, we see bars going to the right, which means unemployment going up. So this is the year over year change from unemployment from the first time interest rate cuts were made. So again, this goes into the face of the narrative that lowering interest rates is good, quote unquote, good for the economy. We don't see that in unemployment. We see unemployment rising after the first cut. Now, we are a real estate focused podcast. So the last data set we're going to take a look at is housing. And this is going to be the median year over year change in home sale price in the US. Now, similar to when we took a look at the stock market, it's overwhelmingly positive. Again, we do have 2 outliers of series of data where home prices actually fell during a rate cutting cycle. However, overwhelmingly, we see prices increasing. The difference we're going to see here between housing prices and the stock market is that when we go back to the stock market, we see the average for that data set lagged the historical average. Housing is not the same. So the average home price appreciation during a first rate cutting cycle is about double what it is for the historical average for home price growth. So this would lead us to believe there's some data that would suggest interest rates coming down has a significant impact in housing prices. The takeaway from all of these data sets is that don't necessarily believe right out of the gate that lowering rates is going to have a significantly positive impact on the economy. We don't see it necessarily in the stock market. We certainly don't see it in employment numbers. You can make the argument that there's enough evidence to support lowering rates is great for housing, and whether or not you'd want to rush out and go buy a house now versus waiting. Housing is always going to be more of a local matter. So yeah, interest rates do play a role, but your individual market is going to play more of a role in whether prices are going up or going down versus interest rates. But the takeaway here really is that as rates continue to come down, we don't see overwhelming evidence that it's going to have a significantly positive impact on the economy.